So the Nasdaq continued to make a strong run to the upside today. It's almost like that champion that that they just won't go down. You think you have them against the ropes, you think you can dethrone it and make that rotation into other areas of the markets, and the champion swings back and gets back into the fight. Well, that's what the Nasdaq did today. The question is it just a one-day thing, or is it going to be a new leg higher? Or are we going to get a new intermediate run, like for multiple months? So I'm going to break that down in today's video, and we're going to look at how overbought we are. Are we extremely overbought? It seems from the chatter and the discussions that we are so overbought that this is like 1999 all over again. So I'm going to break that down as to how overbought we are and what that means in terms of how much potential we have going forward. And then we're going to take a look at our trade idea of the day with a stock that had earnings here in the aftermarket. And then what the expectations is for that stock coming out of that earnings event. So let's go ahead and get started. Today is Monday, July the 20th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we came really close to a cluster. In fact, all four lines are not above 80, which would define the overbought cluster, but they all are above 75, including market sentiment. So it just kind of shows. I mean, we just had a 34% frickin' drop in 4 weeks, like one of the biggest drops of all time in that short amount of time. And the market sentiment, we're almost got an overbought. Just a few weeks later, couple months later, we've got a overbought cluster with all four lines up above, at least as of right now, up above what, 77. I mean, just all of them. And we got the momentum at 76.96. So all around 77 or higher. So it just goes to show just how strong this rebound has been. Intermediate line up above 90. Strong bullish posture. It's really kind of hard to fall off a cliff from such strong bullish level. Doesn't mean we can't come down. It just means that don't expect, like, we came down from 90 over here after we had been up for a while. We had a little leg, like we probably should have come down more right here. This is probably where we should have dropped down, kind of like this. I think this is where we probably should have stopped in a normal kind of bearish market. But because of the Saudi Arabia and Russia oil spat that really exacerbated this, that's this drop here. Things got really bad really quickly. So that's what really kind of exacerbated the problem that probably would have stopped here, that probably should have started here. But we had this kind of divergence. There were so many divergences during that leg higher. So we would have had a nice little rally here. And then who knows where we'd be right now. To be right where we're at here, there probably would have been some highs, and we would have had a little bit of a pullback into this area potentially. Who knows, right? Who knows how things would have worked out had it followed kind of normalcy. But we had, again, this very abnormal move, and because of the abnormal move to the downside, we had an abnormal move to the upside as of right now. Now we're settling in, right? Now the move we get from here going forward is going to be a normal, relatively normal trend. The VIX is still pretty darn high, but just remember that the move up that we've had is a function of that drop. That's a very abnormal drop in such a short amount of time. So the move up is a function of that. The pullback that we first get, the first intermediate pullback we get that brings the green line below 50, will also be a function of this rally. So until we get that pullback, until we can settle into support wherever that ends up being, it's probably around that 38% area. That will probably fall back any more than that. Now, granted, as you move this up, if we keep going up here, you'll have to keep, that 38% line will rise. But there's going to be some support in this area. As of right now, there's some pretty strong support in this area. So if that's where we end up dropping to, then after we come off of that, you'll start to see some normalcy. The VIX will start coming down into the 20s again, and then below 20, and then you'll be kind of set on the normal trend. But until then, we're going to have, this decline will set up any move we come after this. Big, small, like, it's going to be bigger than you will ever be comfortable with. Like, that drop was obviously bigger than anybody was comfortable with. But you notice it didn't kill us. Like, we're still going strong here. Our class portfolio is still doing very well in our trading rooms at Market Scholars. So, as crazy as that was, we have since bounced, doing very well during this. And we're going to drop again. And it's going to be very uncomfortable to drop to 2,848. If that's 400 points right now on the S&P, if that's what we end up doing. And there's always pullbacks, right? There's always ups and downs. We never just go up forever. And the longer we go up without an intermediate pullback, the bigger those intermediate pullbacks. I mean, even here, because we went up so far, that extra little leg, even just dropping to this level, which would have been kind of a normal, that was well more than 60%. That was pretty much all the way back down to these lows. So that was a pretty significant intermediate pullback. That was a function of an extended intermediate rally that was probably longer than it should have been. Probably wouldn't have been so bad had we pulled back here first and then kind of hung around here. Like in fact, for an example, let me show you from this low point here. From this low point here up to that high point, before we started, you can see how the initial declines was just a 23% retracement. Had we come down into this 38% then and there, see, that's not a pullback, right? You don't get a pullback until you break the 23. So had we just pulled back into this 38 then and there and kind of held, then we would have held in this area, even with with this coronavirus scare, and then potentially bound. Then we would have had some volatility with the coronavirus, probably not 34%. And remember, the oil spat also threw a wrench into the equation. But you can kind of see it, getting another leg higher and going that extra month, 4 months into an intermediate rally, it's typically 1 to 3. Then by then, even without that oil spout, we had dropped through the 62% retracement all the way down to the 78%. And we were holding up just fine here, because once you break the 78%, that's when you start looking at, long-term bearish, trend change. And we were just fine. And even with all that, we would have held up. And again, this drop, a function of, a longer than normal intermediate rally. So we came, but we're holding up the 78. It would have had some volatility before we broke back above the 23 at some point in time and started a new trend higher. But the floodgates opened coming off of that weekend here with that oil news coming over the weekend of March 6th to March 9th. By Monday, we had already opened up down sharply. We finished down sharply, and from there it was just, we were below the 100% mark at that point. We fell all the way through the 162% retracement. We were falling like a rock at that point. But again, we came right back and got back to that old 100% level here pretty quickly. Didn't take very long. Shows the resilience. In fact, we almost got back up to the 100% line as fast as we fell through it. Then we were kind of fiddling around with that area in that 78% retracement before getting back up above it, getting back into the retracement zone, kind of holding that 78 again here, and then now obviously getting back and through. So you can see how these lines continue to even to serve, especially when they line up with some of these other drops and bounces. Let me move this drawing here so it doesn't cloud us up. But we're easily above the 78% now. We are changing the trend to the upside. So we're not looking for a new retest of lows. We're just looking for an intermediate pullback at some point in time. Who knows when, right? And now, granted, we've been above 50 now in the intermediate line for over 3 months, 3 months and a week. We're going on our 4th month. So ideally, we would like to have it sooner rather than later. Once we get to 4 months, we see what happens. Again, even without the oil spout, we were through the retracement zone. So we don't want that, right? We don't want 4. We don't want 5. We've seen what happens with 5 months too. Back in January 2018, that led to a pretty significant decline. So we don't want 5 months. It would be nice if we were to get a little bit sooner rather than later, but we'll take what we get and respond to what we get and ride the trend while it's still going. And it's pretty strong. Again, to the point where you almost have an overbought cluster there. The Dow is almost back above its market sentiment line. You can see the S&P has crossed above its market sentiment line again. The Dow's not quite there. The NASDAQ is not quite above its market sentiment line, but at least it's back to dark green shading, and actually almost got to cluster itself too again. Everything above 74 here, almost 75. And then finally the Russell 2000, like the Dow, almost back up above its market sentiment. It has a yellow line, but at least we are holding that breakout from last week where we got above all these highs. Haven't been able to go anywhere, but haven't dropped down either. So oversold momentum line, you would expect, it can bounce tomorrow and like the S&P and the NASDAQ, retesting these highs and potentially working that zero line up all the way up to these old highs. By the time potentially that this intermediate run is all said and done. But like I said before, if that's the case, if we do get up to this 100% line by the time all is said and done, then just know how far that 38% retracement is going to be. It's the further we go up, the bigger the intermediate pullback will be. It will be uncomfortable, but it will just be a function of how big the rally is, and it won't be bear market. It won't, even though people will be touting it because it will be close. It's like a 15% drop is what it will be to get to the 38% line. So people will be looking at like we're in a correction again. We're headed towards bear market potentially because of these numbers. But the reality is it's just a function of going up 30-40% in a short amount of time. That creates big runs, create big pullbacks. It's simple as that. A 15% drop over here is significant, right? A 15% drop coming off of these really slow grinding moves to the upside. 15% drop over here is nothing because of a 30 plus 40% rally that precedes this one. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when these videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video. And number two, it tells us that you want us to do a video again tomorrow. If that's the case, click on that thumbs up and let us know. You can do it right now while you're watching. If you don't want us to do these videos, then you don't have to click on anything. And then comment. What questions or comments do you have about anything we discussed in the video tonight? Post that down in the comment section below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, you can check out some of these other things like the Market Outlook Live. Every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time. You would have wanted to watch today's because today's trade idea we posted before the market closed in this live trade review, and it's up 5% in the aftermarket, in the after hours. So that's one of the benefits of this is that you get the trade idea before the market closes if you're able to watch it live. We also review all of our old trades, and we've actually made we've been managing quite a few of our trades here that we've been putting on old Market Outlook videos. So to be able to stay in tune with those, make sure you check that video out. That's all of our subscribers, even our monthly subscribers, get access to those, as well as our monthly subscribers also get access to all of our trading rooms too. So if that's something that interests you, click on this link right here above the video to get more information. You can also see if you mouse over pricing. There's our monthly plan. Our premium plan includes all of that, as well as all of our premium tools and access to our communities for each of our classes here, as well as all of our custom content that we create for those trading rooms. All right, let's get back to the charts, and let's take a look at the long-term chart. Good bullish Hakinyashi candle here. In fact, the PPO is rising. We got to get this moved up to where we are, and just to kind of give you an idea, we're at 3.2 now on the PPO. In the last so many years, we're high, but we've spent a lot of time higher than this where we're at. So very good. We're at the beginning of a golden cross potentially. And you can see, if I give you some perspective, you can see how long golden crosses can last. They can last a long time here. So we got a bullish candle today, up high, or so far this week. It's only one day, but higher high, higher close, no lower shadow. So far so good on the long-term trends. You can see the Dow is getting a golden cross finally. The NASDAQ, it's a little slow. Like was a great day today, but it's still a lower high from last week. We barely got a higher close, and we're a lot closer. We did go up 300 points in the Nasdaq, but that just kind of shows, that goes to show just how close we are to forming a lower shadow. So just something to keep an eye on the Nasdaq. A little bit of, we'll see how strong. I mean, this PPO for the Nasdaq, for the S&P, we're kind of just getting going, but on the Nasdaq, we are relatively high, 11.89 here when you round up. There we go. If you kind of look at the how far back we go here, again, 99 was the highest. Now, in 99, coming off the late 98, I've compared that to this. There's lots of signs I've compared this to that level, especially when you don't look at it on a arithmetic chart. If you look at it on a log scale, it doesn't look so bad, right? Now this looks a lot more bullish than where we are right now. But over here you can see late 98 coming off of that fall of 98 big kind of period of volatility, similar to what we got here. It took off into 99 in the beginning of 2000. The PPO got a lot higher, and the PPO in the late 90s all the way into 95, 96, 97. Remember, 95 was the period where they had the drops in interest rate, the mid-cycle adjustments we've talked about before, when we had mid-cycle adjustments over here last year in 2019. So high PPO levels, very similar. So this is relatively high, but even at these levels, it didn't necessarily cause us to immediately fall. It slowed us down a little bit, it limited our upside, but even in 98, it took off from here. It took off even higher to some really strong returns. So we'll see if this limits us now and gives us a pullback back down towards that 200-day moving average, or even just see, you can see a 38% retracement is well below the 50 right now, and by the time we did hit it, probably within a few weeks, your 200-day moving average, which is above the 50 here, will be at the 38%. So a 38% retracement would be testing by then, potentially testing the 200-day moving average. Again, people would be freaking out when that happens, because we're testing the 200-day moving average, blah. But the reality is, it's a function of this rally. This rally, at least initially, was a function of that drop. Now it's just it's actually maintaining the really strong trend you had going into that drop. So first it was a function of the drop. Now it's just a matter of continuing the trend that was already on before this coronavirus thing just accelerated what we were already seeing going in to the coronavirus issue. And finally, the Russell 2000, good bullish week, trading well above its 200-day moving average finally, and still no golden cross yet there. So it kind of shows, just how not overbought we are from a broad risk appetite standpoint, and how we're just kind of more overbought in a small segment that can, in and of itself, still, there's precedent for it to even take off from here to, even higher long-term momentum levels. So don't just bank on the fact now that we're going to drop immediately, because the precedent that we compare ourselves to show that wasn't the case even at these high levels. Let's take a look at the three green arrows. Obviously 3 green arrows across the board. The 2-line versions, you can see we're still easily trading above the 8-day moving average on the S&P. If you look at IWM for the Russell, we broke out and finally got above the 30 and the 8 and the 17 and all that, and still with the weakness still holding. A little bit of a pullback on the MACD, but the stochastics is back in the area where buyers are in control. So we're actually doing pretty good from the intermediate standpoint. From an RSI, we're back above 60 we're still above 100, we're back above 60 on the RSI, so good strong move there. The DMI is showing re-emerging bullish patterns with a rising ADX. Again, does not show that we are, again, the end of bullish moves tend to happen when the ADX is extreme, and it's still not extreme in the least bit here. It is on QQQ. It is getting that way on QQQ, but even then, it's still got a lot of room to run before it gets to abnormally high levels that typically signify the end of these big, long, intermediate runs. We've seen multiple instances in the last little bit, again, and here at the end of, right before this pullback here, you can see in coming off of the Q4 drop, the move that we had in the early part of 2019. We never did in 2018 get very high in the ADX, so there's a potential sign that we can replicate on the S&P. Going into 2018, you can see the ADX getting really high in a bullish level, and then of course a few times in 2017 when we were in the midst of a really strong run and falling dollar move. So plenty of instances and plenty of opportunity for the ADX to rise again, which again leads us to, again, that it looks really overbought on this chart, but it's deceiving because it's not a log scale. Now it doesn't look so bad, right? When you're on the log scale, it doesn't look nearly as bad, and it can still make a run up to get to, abnormally high levels again that would limit any upside that we have from there. Let's take a quick look at before we look at the intraday chart. I forgot to show you the Bollinger Bands for SPY. Again, clearing this node is going to be a big deal because you're going to get out of the value area and you got path of least resistance to the upside. See, we have that for the Qs. In fact, we're well above the value area for the Qs, and we're forming a little bit of a node here, and then we had today's breakout. We are not quite there in the diamonds. We're still kind of figuring out this area. And then also in IWM, we're still below the point of control for the past year. So again, it goes to show that from a QQQ standpoint, we're pretty bullish. We're not extreme, but we're pretty bullish. Everything else that's not so influenced by the Qs, we're not even close to being extremely overbought, or even overbought in the least sense. So again, big rally, but only because it's a function of the drop, right? It's not a function of being kind of bullish and then it just takes off, parabolic moves. No, it's a big rally because it was a big drop, and so that doesn't mean we're overbought right now. It just means that we're finally catching up to, if you look at if we had just kept grinding from here, you can see, like, let's say that we instead of dropping here on this coronavirus, we just kept going up, and eventually we finally started to pull back, from whatever high levels we had. You can see we would still, right now, we would be pulling back all the way to those lows. So again, that's not extremely overbought at all, and that was a grinding trend. That wasn't like a parabolic move either. That's a grinding trend, and if we had pulled back from that level to current levels, it would be 100% retracement. That would not be extremely overbought in the least bit. All right, now let's take a look at the intraday chart here. And you see right here, there's our new 4-week high point. It looks nice and bullish from here. So you can see the near-term run that we're on, the current near-term run that we're on. If we go back to the market forecast, started back with this move off of the low point on 714. So that's our current near-term rally, which is this low point here. So you can see, in fact, I have to raise this up, this 0% line here, activate that drawing, and raise it up because we have new highs. So let's move it up there. So you can kind of see now, a pullback, a near-term retracement down to 38%. Would be down to this 320 area from 324 to 325, if not all the way down. I would expect actually to probably come down through that into this 317 area if we were going to get any kind of near-term pullback anytime soon. And of course, if we continue to push up, you keep moving those highs, those levels higher. But today's volume, 56 million, not very high, below average. So we're still on the range. We're still not there yet to where the range is saying, okay, here we go. We're still just flirting with the 2% mark, which, absent this coronavirus drop that we've had, would be relatively high levels, right? We'd be pretty bearish, which again goes to show just how not overbought we are, because these are still high levels. The ATR is, again, at this level would have been really bullish. Now that's not apples to apples because we're at higher numbers here, so you'll have a higher number. But this is a relative number, and it's still really high. So once you get below 1%, that's when you're solidified into a bullish trend, and you're not just bouncing off lows like we currently still are right now. And then finally looking at the VIX. Whoops. Next one down. There we go. Finally looking at the VIX. Finally we have broken. We've been flirting here, and this is a good sign that we've broken to the mid-20s. We've broken below 90%. We are solidly in the bullish zone here. We're not extremely oversold on volatility, which would be the 80% mark, but we are right smack dab in the sweet spot of the bullish zone for volatility, right at the 85% mark. Cannot be more bullish than that from a volatility standpoint. The nice thing about that dropping like it has is when we do get intermediate pullback, again, hopefully sooner rather than later, then volatility won't jump up very much. It won't jump up to 125% again. It'll probably jump up towards 100%, which is typical of intermediate pullbacks. And again, once we get through there, then we're worried about it being more than just an intermediate pullback. And that's just not an issue, not on the plate right now because of how low it is. So very, very good signs, very good bullish trends. It doesn't mean we can't have an exhale, and the exhale will be bigger than you will be comfortable with, but it's just a function of how much we've moved, and it'll be nothing more than that. And once we start, once we get the ATR down to those, below 1% too, and the VIX is down below 20, then we'll be kind of entrenched. Like I said, we won't be bouncing off of a big low point anymore, and that's kind of what we're still doing. Is we're still bouncing off this big low point, and that's why it's so big. The rally has been so big. Eventually, we'll just start trending higher, right? The low point will be behind us, and we'll just be trending higher. And we're not to that point yet where we're just trending higher. We're still just bouncing. We're bouncing a lot because, think about like a trampoline, right? When my little 8-year-old jumps in a trampoline and you're looking at it at eye level, there's a little bit of a dip there. But when I get on the trampoline, then the low point almost hits the ground right before I bounce all the way back up. So that's what the trampoline did, and we're bouncing up higher because of that. My little 8-year-old doesn't bounce very high because it doesn't go down very low. And that's what we're doing here in the markets. Let's get a breather, and if we go 4 or 5 months, then that'll be okay. Let's just ride what we got, and Qs are leading us up still, and that's great. As a very obvious leadership, we'll ride that leadership. But again, the longer it goes up without that exhale, the bigger and more uncomfortable the exhale will be. And if you can withstand that, great. If you're kind of weak hands, like a lot of retail investors are, then you're going to be cursing the Fed and conspiracy theories here and there and everybody else because we couldn't handle the risk. We've got to be able to handle if we want the rallies, we've got to be able to handle the pullbacks. Otherwise, we won't be able to manage our risk, and we won't survive this doing it on our own. We'll just have to put our money in the SPYs and call it good and never look at our statements. And that's not what we do. You wouldn't be watching this video if that's what you wanted to do. So that's kind of a summary, and we'll take a look at some more charts here in just a minute. But what do you think of that technical outlook? Do you agree with that? Do you disagree? Comment down below, especially if you disagree. Either whether you're more bullish or bearish than I am. Share with our community what you're seeing that drives that opinion. Obviously, everybody's got an opinion, and everybody likes to share their opinion online. But what's more important is what's driving that opinion. What indicator what chart are you looking at? So that we can have all the information, be able to see all sides ourselves. All right, that was a little bit of an extensive outlook because, again, it's kind of 2 videos in one here. So let's briefly go through what's driving this price action today. Again, here's the leadership. Small caps are doing well. They're holding up. They're outperforming SPY. They're just not outperforming the Qs. The Qs continue to be the strong leadership to the upside. Emerging markets are also maintaining some decent strength, close to their 3-month highs as well. So that's a good sign. The SPY is now getting its own 3-month highs. EFA is close to its 3-month highs. Gold is hitting 3-month highs today, so strong move. Commodities are also, DBC is also at 3-month highs, and that's all coinciding with this dollar. This has been on our radar for so long, and the dollar's continuing to drop, giving us an oversold cluster today. But again, as you see on that weekly chart, we've got, there's potential for this to be a long-term move. There's going to be some swings up, but there's potential to have a long-term move to the downside, especially with the euro breaking through some pretty significant technical levels. Let me go back here. You can see breaking up. In fact, I have to go back even further. Breaking up above some pretty significant, breaking up of that 38% retracement. This time with a much better chance of holding than the last time. You have to keep an eye on that potential intermediate divergence that we have going on. Let's see if we can get through and get up above. I'm not too concerned because you can see this is a daily chart, mind you. We just barely got above. This is a couple months ago. We got above the market sentiment line. So there's a good chance we can stay above it here for a period of time while we're inside this retracement zone. Now that we've cleared the 38% here and we've held the breakout, and we'll see if we don't break up and grind our way to the top of that. Again, very bullish. If we were to do that, it's a very bullish, for risk appetite as a whole, for the dollar to go down and for everything else to lift their ways to the upside. If you take a look at TLT, interestingly enough, again, as a function of how overbought we are in terms of risk appetite, this safety trade is still pretty bullish. So we still haven't really had a good sell-off in bonds to show how strongly overbought we are with risk. And of course, gold is strongly bullish, and that's the case because of the weak dollar. But it's recently got overbought clusters. It's got strong trends, and you can see even its weekly chart is. Its market sentiment line on the weekly chart is still moving higher. So, this is also a safe haven asset, but it's also an anti-dollar trade. So that's why I'm not too worried about this not falling. In fact, I kind of expect this to continue to rise while stocks rise, and because of the weakness in the greenback. It is a good sign, however, that we are seeing. Let me come over here. That we are seeing commodities rise up. Here, let me go to the Bollinger Bands, because commodities have this big volume gap to fill, and this is a lagging asset class, so it might not break into it on the current intermediate run, but on the next intermediate run you can see just how bullish this can get if we were to get into that volume gap and make a run up towards 15, if not up to its point of control for the past year. So there's a lot of opportunity for risk appetite as a whole to rally, even with one narrow segment, this large cap tech space, kind of being itself pretty strongly overbought, not extreme, but pretty strongly overbought right now. The tech sector continues just to kill it from a sector standpoint. If you take a look at this comparison here, there's your tech areas. Materials is doing really well, and industrials had a good run, not so much today. And energy also, you had some pretty strong, pretty decent drop in the dollar, but that didn't really reflect itself in the sector rotation today. In fact, the dollar sensitive areas all kind of lagged and underperformed. Energies, materials, industrials. Now, Safe Haven also, look at Safe Haven. Safe Haven didn't just lag with positive returns today. They dropped. And then you also had financials down, even with bonds. Bonds still kind of rallying, and that's putting some pressure on financials, coming out of their earnings season for a big chunk of them. And then healthcare, kind of a buy the rumor, sell the news, with a lot of news coming out positive for healthcare. So again, this just reflects what's been driving risk appetite, and that is these areas. It's been the leadership. It continues to be the leadership. As you can see, let me refresh this page. That we're up to, look at, this is last week's drop. Here, let me go to a daily chart. We'll go back to a daily here, and let's go to just 5 years. Let me switch these back to 50 and 200 days. And then right here. All right. So here's the drop that we had the last so many days, and look in one day how much of that last week's drop we recovered. So, again, as much as we want to write the story on this rotation from growth into value, it's still not there, right? It's still, this is still a strong move in growth, and it's a strong trend, and we don't want to fade or short that trend until we see some pretty decent signs of reversal that we just haven't seen yet. Even last week, it was just a drop to old highs that we had cleared previous to last week. So we're continuing the strong trend of movement in these tech areas. We're continuing that going into, and again, like I said, 3-month chart. When you look at the 3-month chart here, very strong returns, 20% returns versus 13 for the market as a whole, versus some negative 3-month returns for these safe haven areas. If you look at the 12 grid here, and you see these cyclical tech areas here at the top, very, very strong intermediate lines. Overbought cluster on communication services, not so overbought in financials or industrials. Materials, pretty strong, but look at these. Look at energy, look at real estate, look at utilities. Staples not so bad, but it's a low number. Looks kind of strong compared to these others, but a much lower number compared to those others. And you see the weakness that we're seeing in these safe haven areas. It kind of reflects just how bullish they were before this whole coronavirus thing hit. We were pretty strongly overbought in the safety trade, and that safety trade's unwinding, and that's a big tailwind to the markets. And there's apparently still some unwinding left to go that will continue to be a tailwind for risk going forward from here. All right, and that brings us to our trade idea of the day. Let's take a look at IBM. IBM has been an interesting stock, and it had earnings out after the market. And you can see we had a pretty decent breakout. That's why we traded it going into this earnings. And then now we're up, at $6 as of right now. Again, things can change dramatically by tomorrow morning, especially if broad risk appetite impacts this. So don't bank on that $6 holding as of right now. But it's pretty strong after hours response. Something that we were looking for. That's what we talked about in our Market Outlook live session. Its market sentiment line is rising. Its near-term line getting back up and staying in the upper reversal zone for a while here, different than the last time. Near-term line close to getting above, coming off of an oversold cluster. So it kind of shows where the floor is. This can act as a support level for the stock. Considering the market itself has been so bullish, and we actually had an intermediate pullback, dark pink shading and a red line, and an oversold cluster to boot on this. So it's got a lot of room to run, potentially. You can see it also getting above its Ichimoku cloud today. You can see a little bit of a breakout again before the earnings announcement. Obviously well through the cloud now. It's up to 132 right here. There you can see also some other good signs. Again, all these before the earnings announcement, getting above 60 in the RSI, well above 100, flirted with 200 a few days ago on the CCI. You look at the DMI and the ADX, you can see getting above 30, below 20. Very good pattern here. Lots of room before we even get light pink shading, much less dark green shading when you start worrying about the end of a trend. So we got room to run there. I think have I mentioned already the Bollinger Bands? You've got the point of control here at 134. So we'll see. We're pretty much there now. So we'll see if this earnings can provide some push to get us through that, or if that ceiling is going to end up holding. That will help dictate, how we exit the trade and how much profits we end up getting out of it by the time all is said and done. From a long-term perspective, again, another sign of potential reward going forward from here. Not only is that point of control at this area here, 134, but you can see that's well above the 200-day moving average. So we've got a good breakout here as of right now. Now, last time we tried to get through, it didn't hold. So we'll see if it holds this time. A little bit higher momentum at this point, and a stronger move. So we'll see if that ends up holding this go around, this time with an earnings announcement to try to help it hold. So we'll see if that ends up being the case. So what we did, we were looking for a bullish speculative trade because of the earnings announcement, and we decided Okay, well, let's go ahead and take a look at buying an out of the money option to try to avoid this volatility crush as much as we could. I didn't go out very far in time because I decided to sell an option. If I'm just going to buy an option, then I'm probably going to go out to at least a September, if not October. Again, another reason to avoid that volatility crush. But because I'm selling an option too, the volatility crush actually helps me with that. So we sold the 140 to help finance some of that long call purchase. There's my maximum gain. Now, granted, this shaded area is going to change when volatility drops tomorrow, coming off this earnings announcement. But we're getting pretty close to the long option because of this rally we've got so far. So it doesn't show a whole lot of gains yet because it's not reflecting the after hours trade yet, just the position, not the options pricing hasn't been reflected yet of the change. So, and we'll see if that move even holds. But that's kind of the idea, is that we get up to 140, if not through that. So for a few $100 of risk, 426 at the worst, we have a potential $2,600 reward. Well, that's a really good reward to risk ratio. I'm more than willing to risk a few $100 to try to make 2,500 any time of the day, and twice on Sundays, or whatever the saying is. So that's our trade idea for the day. And that wraps us up for today. Again, the trade ideas are meant to be kind of like a small window into the trades that we do in our trading rooms. For example, we've got plenty of these QQQ type names in our directional. The class I do tomorrow is our directional option strategies class, and we've got quite a few tech names in there. They have been doing really well too. We've shed some little bit of dead weight here and there, and kept some really good winners, and we're continuing to ride them into today's move, and we'll see how long we ride them before we start seeing some signs of weakness. So again, all these trade ideas, I do manage these trades in conjunction with all the other ones I do from our trading rooms. So this gives you a taste of what our classes are like. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content between the videos. Don't forget to subscribe to our site, as I showed you earlier, and join our Facebook group that we have. Have a great rest of your Monday night, everybody, and we'll see you all tomorrow.